Okay, hello, this is Dr. Flight, and we're going to spend a couple minutes here talking about cost-based pricing decisions. So as we look at this different topic, this different type of pricing, spend a lot of time in marketing focusing on demand-based pricing, which would primarily focus on what consumers are willing to pay and where what type of market we want to sell our product to and where they are on the demand curve. Cost-based pricing takes a very different approach where we look at the internal costs of the product or service that we're providing, and then we build on top of that a certain amount of profit margin that we would like to extract. So that's what this topic is about, and again, it's a very popular way to price. A lot of firms use a cost-based pricing approach to form price strategy. And so that's why it's important to talk about and to go over. So as we look at different cost-based pricing strategies, we'll go over the way they're developed and the way they're created here in a minute or two. But just keep in mind that there are specific advantages and disadvantages of cost-based pricing. So one of which is, or the advantages of this deal with the simplicity of the method. It also ensures that every time we sell a product, the product will be priced at a profit. So there's very little risk or downside component of, of each sale. We know we're going to make money when we take our costs and then add to our costs some type of profit. The other thing is, as we're in a planning process, if you know how much money you're going to make on each product you sell, then the planning process and those calculations end up being much easier. Disadvantages, as you can imagine, it doesn't take into account the demand that the consumers are willing to have, or the amount of money consumers are willing to spend, for instance, on a particular product. So this could mean you're either overpricing or underpricing if you don't take into account what consumers would be willing to spend. And also sometimes it's difficult to estimate cost per unit, especially when you're thinking about fixed costs and spreading fixed costs over multiple product categories. It's kind of a hard thing to do sometimes. So moving forward, when we start looking at cost-based pricing strategies, what are we dealing with? Well, first and foremost, we need to understand what costs are in order to be able to build our pricing model. So a variable cost is a cost that can be associated to producing a single unit of product. Variable costs fluctuate depending on the number of units that are produced. So the more units that are produced, the more variable costs that you may have. Fixed costs are costs that are generally static regardless of production capacity or overall production. Now this fluctuates a little bit. Sometimes there's a stair-step cost based on units of production. So in other words, we might produce a number of units at one cost, but then once we hit a certain benchmark or threshold, maybe we have to build a new factory. And if we have to build a new factory, then our fixed cost structure changes. But generally speaking, we use this idea as a base set or a set price or cost associated with all production. Again, one of the challenges that they're going to be associated with this is determining exactly how much fixed costs we should associate with a per unit of production. So as we move forward, we can look at this a little bit more closely, where we take this unit cost, we add to it our variable cost, which we know that's just the individual cost per unit, like so for materials or direct labor or something like that. But then what we want to do is we want to take our total fixed costs and then divide it by our demand or the expected number of units we're going to have. So this way we can calculate or estimate at least how much of the fixed costs should be specifically allocated to each unit of production. This will give us our per unit cost, and that's really what we are kind of thinking about when we're setting price. Because generally speaking, we're selling one unit, so we want to know what 1 unit of cost is. That's why this fixed cost thing is actually kind of a challenge. If you have lots and lots and lots of different products, but we have one fixed cost that's associated with all the different product categories that you sell products in, it may be very difficult to determine with a lot of accuracy how much each unit of a specific product should account for in terms of that fixed cost. So oftentimes firms have some difficulty or trouble estimating what those per unit fixed costs are. But anyway, you come to it, we need to have this unit cost. We need to know what this is before we can do a cost-based pricing strategy. There are really kind of two different types of cost-based pricing strategies. One is a nominal markup and the other will be a percent markup. When we do a nominal markup, we take our unit cost and we add to it some type of a fixed amount, so some set amount. Oftentimes it's a dollar amount if we're talking a nominal markup. So in this case, we have a price would equal a cost plus some type of markup. So let's say we have a unit cost of $25. I'm not sure what this product is, but it has a cost of $25. And then we're going to mark it up a certain amount of money, in this case $10, and that will set our price. Now, I've drawn on here a demand curve that's on the chart, but it really doesn't need to be there, right? Because this price was determined not based on cost at all, or not based on demand at all, but rather based on based on this particular desired $10 profit margin that we wanted to have. Another way to do this is to use a percentage. So say we want to, instead of a nominal amount like $10 in that last example, let's say we want a specific nominal amount or percentage that's specified. So in this case, let's say 20%. So 20% of $25 is 5. So a 20% markup on a 20% markup on a $25 cost would be $5 added to the 25, which would give us a $30 sales price. Again, we're sort of marking this up a certain amount. So in the last case, we said we wanted a $10 return or profit, so we had a $35 price. In this case, we want a 20% return, and so that would mean that we mark up $5 and we'd have a $30 price. So this is important because sometimes firms will say explicitly that they want to have a very specific return on investment, and in this case they might say, well, we want a 20% return on whatever activities we do. So that would be the benchmark that we would use, and that would set the percentage of what we're charging. Okay, so those are the two basic concepts that are associated with cost-based pricing. They're pretty straightforward and pretty reasonable to grasp. Now I'm going to move on to another topic just because it'll make sense here in the context of what we're doing, and that would be some errors or some problems or challenges with pricing. So in another lecture you've seen information about demand-based pricing. In this lecture we're talking about cost-based pricing. Other things that you're worried about with pricing